this meeting of the Collection Fund Network. Just a few housekeeping rules before we start. The meeting will be recorded, so it's just worth bearing that in mind if there's any comments or whatever you wish to make during the course of the meeting. And we've also encouraging people, if they have any questions during the presentations, to use the Q&A button, which you'll see on the top of your screen. There's obviously the opportunity to use the chat function as well, but I think we perhaps reserve that for the final general session after 11:40. So as the essential structure of the day is 10:05, Adrian Jenkins will be making a presentation from Pixel, and that'll run for about 25 minutes, half an hour. And then at 10:30, there'll be a presentation from LG Futures that will run to 11:15. And then there'll be a short break, and 11:30, Mike Heiser from the LGA will just give a short update from the LGA's perspective on where we are on local government finance and funding issues. And then there'll be a short discussion period, about 15-20 minutes, just on general emerging issues or any concerns or any just general questions you have. And I'm hoping some of the speakers will be able to join that as well, to deal with any questions that I or other colleagues aren't able to. So if you've got any general questions, you're welcome to leave that for the final session. So I think on that basis, I'll hand over to Adrian Jenkins, who's from Pixel, who's the first presenter to make his presentation for about 25 minutes, half an hour. Okay. So over to you, Adrian.
Cheers, thanks, Martin. Okay. So thanks for that introduction, Martin. I've got a 25-minute slot now to talk about. It's kind of about the settlement that we had just before Christmas. But when we're talking to Chris, when we're trying to work out what subjects to cover, I realised that I've done the settlement presentation at least 2 or 3 times, and some of you have possibly seen it on all 2 or 3 of those occasions. So I didn't want to go over too much old ground. And it's obviously you've got on with your budgets now. We're just waiting for the final settlement. So we'll cover some of the ground around the settlement itself from December, but also try and look a bit further ahead, into 24-25, and look a bit further ahead if we can as well, to see if there are any indications from this year's settlement and next year's principles that give us an indication of what might happen in 25-26 and further ahead. So try and take what we do know and talk about the settlement that we've just had, but also try and just look further forward. We'll start off just trying to cover some of those final things around the dates of the final settlement, when we think it is and what that means for the rest of the year. But then cover some of the things like, of course, spending power, what actually happened with that sort of main measure of the funding that we get from the settlement, distributional issues, and what that means possibly for fair funding review further down the line. We'll look at in quite a bit of detail at council tax increases, what the maximum increases are for this year and the next year after as well. And clearly this is one of the key things that you're still wrestling with, I'm sure, within your own authorities. How much will you put up the council tax? Will you use the maximum threshold or not? And we'll try and just look at some survey data and some past experience to see what that might mean for you. And then look at things like some of the core grants, how they were increased in 23-24, what that means for next year, social care, and then the issues that the next 3 topics, the 3 issues that I've had most questions on over the last couple of weeks. The 3% funding guarantee, how does it work? And will it continue for next year? New homes bonus, again, will that continue next year? What are the alternatives, and what's the process for finding that out? And then cap compensation, just because it's so complicated this year, working out what that means for your budgeting is quite tricky. So we'll look at that in a little more detail. But I think Chris and Caroline will probably cover that in more detail later on. And finally, the last piece in the jigsaw that we've heard nothing about yet, which is the public health grant, which once again is very late in the process. So let's start off with some speculation about when we think the final settlement might be. We had this new, I've called it an interesting experiment, the policy statement that came out on the 12th of December. I think the idea behind this was well intentioned in that officials realised that the provisional settlement was going to be very late, later than I suspect they'd intended. And by giving us this policy statement, that was a way of helping us to work out what we would get in that provisional settlement. And it kind of got about 75% of the way there. It gave us the principles, but personally, I found it quite difficult to really fully know what was going to be in that provisional settlement without having the numbers to go alongside that policy statement. So for me, that policy statement looked a little bit more like a summer consultation that was about 5 months too late, rather than something that was really useful to help work out what's going on in the provisional settlement. That provisional settlement itself, it now does seem to be destined to be always in that last week before Christmas. Officials seem to be trying to get it early into the month, but fail to do so for understandable reasons at times. But it just does seem to have got stuck in that rut. Consultation response was a 4-week consultation. That deadline's been and gone now, 16th of January. So we're now waiting for the final settlement. The week beginning the 6th of February seems the most likely. Just talked to Mike before this session, and I think what Mike was saying was that the LGA hasn't been given any indication about when the final settlement will be. If you look at the recent past, the final settlements has been between the 4th and the 7th of February in 4 out of the last 5 settlements. That suggests the 6th of February week beginning is probably the right sort of week. The parliamentary recess is the 10th of February, so we'd expect it to be before that. So the week after next looks by far the most likely, but you can't rule out next week. And then the process for 24-25. I was quite disappointed actually that there weren't indicative figures for 24-25. There was enough information there around the principles to have done so, and I guess it's just because there were some key missing elements that ministers hadn't made decisions on, which is why we didn't actually get figures. But I thought that was quite disappointing. I would hope that there would be a summer consultation rather than a policy statement in December. It makes a lot more sense to try and get those principles out early rather than wait until we're on the verge of the settlement itself. And that's certainly what I've fed back in my response on the consultation, that having that summer consultation makes a big difference to your forecasting and your budget setting. One of those key factors or key announcements or decisions that we're waiting for is the future of the New Homes bonus. In the consultation for the settlement, it said we will therefore set out the future position on New Homes bonus ahead of the 24-25 local government finance settlement. I mean, that's not particularly helpful. That could be the week before, it could be the month before. What we would really like to see is a very clear stance on what's happening really by the summer and by September at the latest, really, for some authorities, for some districts in particular, but not entirely districts, so that some London boroughs are very reliant on New Homes bonus as well. We really do need to know what that is earlier rather than later, and there isn't really much excuse for not knowing and for not giving a decision. We've had a consultation that's been, I think it was a couple of years ago now, so the work has been done in that sense. The consultation's been done as far as I can see. We just need a decision. And then this one really uncertain variable, which is the possible interactions with this packaging scheme and the income that might be forthcoming from that scheme, and what that might mean for authorities and the implications for EPCS funding. Whether that's going to be information or consultation, we don't know. To my mind, this looks like something that is a real uncertainty, and trying to feed that into the settlement, I think, is really quite difficult. My guess is that they'll flunk that and they won't do anything about it, but they won't tell us they're not going to do anything about it until late on in the process in the autumn, no doubt. I'm sure it will generate additional income. We don't equalise or adjust for most other income streams other than council tax, so why this would be different, I'm not sure. It's something maybe to take into account in the fair funding review, but not to sort of shoehorn into the settlement in 24-25. But it's just one of those factors that means we're not getting final figures or indicative figures for 24-25. So looking into 24-25, it's good that the policy statement does cover both this next financial year and the year after. There are still some uncertainties about principles, but the approach seems to be that the core settlement will continue in a similar manner for 24-25. So the major grants will continue as set out for 23-24, which is a good thing. And I think that's the main kind of default setting that we can take for what will happen in 24-25. So things we can be sure about, things like, the elements within settlement funding assessment, BFL and RSG, will increase in line with inflation. The forecast is that could be around 7.4, 7.5% for 24-25, and that any capping or freezing of the multiplier will be compensated through cap compensation. I think we'd be fairly sure about what social care grants will be in terms of amounts and distribution. We know what those amounts are, and there's some uncertainty about how they'll deal with the equalising ASC precept, but I think we've got enough to be able to forecast with some confidence. And also, we've been told what the council tax band D thresholds are, and that they shouldn't move at all, really, for 24-25. But then there are those two things that we're less sure about. We don't know about New Homes Bonus. We don't know in detail about what the form of the 3% funding guarantee will be. It's termed a new one-off funding guarantee. Some form of core spending power related guarantee is necessary, and I think will certainly continue, but what that form will be, we just don't know. So with core spending power, I think one of the key things to recognise is that there have been some really strong, really big increases in core spending power in the last 4 to 5 years, much better than the increases or reductions that we were getting before 2021. The spending review in October 2021 gave us a very front-loaded 3-year settlement, so we weren't expecting any increases at all in 23-24 or 24-25, other than uplifts in council tax. But as we know from the autumn statement, there were some big increases there in funding, especially for social care, but also in those core grants for the inflation uplifts in settlement funding assessment. So I think, one conclusion might be that it's been very good in cash terms, but possibly less so in real terms. Certainly, if you put increases in consumer price index against those increases in core spending power this year, next year, and the year after, they wouldn't look too good. But one thing that I'm always reminded of, certainly when I see presentations from the Institute of Fiscal Studies, for instance, they always talk about the GDP deflator rather than CPI. As you'll see on that bottom bullet point there, the GDP deflator increases are quite a bit lower than the consumer price index, so only 4.9% in the current financial year, 3.2% next year, and only 1.3% the year after. So if you overlay those against the increases in core spending power, things are much more positive. So as a question there for you, I guess within your own authorities, does your inflation feel much more like CPI or like the GDP deflator? GDP deflator is meant to reflect the actual level of inflation that affects public bodies, not the inflation that affects the consumer. But reality and statistics are not necessarily the same thing. One thing I think is interesting is putting core spending power into an historical perspective. A lot of the analyses that we see tend to start off in 2015-16 because, well, that was kind of an inflection point with a general election, a new multi-year spending review. But I think it's actually quite instructive to go right the way back to 2010, 2011. That was when the coalition government came into power. That was when we started seeing cuts in core spending power and the cuts for austerity. And what I think is really, really interesting when we do that is that we see that in 23-24, for the first time, core spending power reattains the level that it had back in 2010-2011. So you can see there that during that period, 13 years, core spending power dropped hugely to the middle part of the last decade, and then has been slowly rising back out of that depression, and that rising quite quickly now. But nevertheless, despite all those big increases in funding, we're only just getting back to where we were in 2010 in cash terms. Forget anything about rising prices or rising demand-led pressures. We're just getting back to where we were in cash terms in 2010, 13 years ago. And if you look within the chart there, you can see that the blue area, which is council tax, that's expanded to offset the cuts in settlement funding assessment and the cuts in other grants. So you can see that's not a good story over that 13-year period for local government. Then looking at core spending power in the current settlement and the changes in core spending power, you can see a really clear pattern emerging here. I guess it's a settlement of three parts, really. You can see on the left-hand side the multicoloured kind of bars showing you the social care authorities and the bigger increases, or really quite big increases, you could say, for many authorities with social care responsibilities, up to over 11% in some cases in core spending power terms. So some big increases for those authorities with social care responsibilities. The green areas in the middle, fire authorities, moderately good increases in core spending power. And on the right, the blue areas, shire district councils. Most shire districts had the lowest increases in core spending power within the settlement. So a very clear kind of three-way split, really, in terms of what's happened with core spending power in the settlement. A chart here I stole from the IFS from their settlement, their contribution to the LGA settlement conference a couple of weeks ago, just showing the way that funding has been distributed on the basis of deprivation. So authorities that are more deprived have had bigger increases in core spending power. And those of you who recall sort of the early part of those Pickles years back in 2010 to 2015, this chart would have been the other way around. Councils that were more deprived were getting smaller increases in core spending power, simply because they had less access, smaller tax bases, less access to increases in council tax. So the biggest increases in core spending power in 23-24, places like Barking and Dagenham 11.3%, Salford 11.2%, Sandwell 11.2%. The lowest increases, places like Tower Hamlets only 6.7%, Rutland and Richmond upon Thames about 7%. Interesting, Rutland and Richmond upon Thames, they've got low increases because they are low need and high tax base. Some like Tower Hamlets, slightly different, low increases because they're losing out. They were doing very well on New Homes Bonus, and as that's phased out, they're losing New Homes Bonus. That's obviously a core component within core spending power. For shire districts, there were some districts that got big increases, not quite as high as some of the highest upper tier authorities, but not far off it. Woking at plus 10.5%, Neaton and Bedworth at 8.5%. Those authorities, those shire districts doing well out of New Homes Bonus, which is why they've got such big increases. There are other elements not quite so good. Then Great Yarmouth at 4.2%, East Lindsey at 4.3%. They're the shire districts that have got the lowest increases in core spending power. And you'll note there that those increases are higher than the 3% funding guarantee. That's because the funding guarantee doesn't include the Band D increases that would be taken into account. And then the fire authorities, highest Cleveland, 6.3, lowest Devon, 5.1. So a relatively small range between the highest increases and the lowest increases for fire authorities, just reflecting the way that their settlement gets put together. So moving on to council tax. Clearly, the way that the government look at core spending power, they assume that every authority will use their full council tax Band D increase. That's the assumption they make when they put the CSP figures together. But clearly not all will do so. And that's particularly so in the current environment because of the cost of living pressures. Politicians will be very mindful of the impact that a big increase in council tax will have on their residents. I'm sure as officers, you'll be putting as much pressure as possible on politicians to increase the council tax by the most that they can. But politicians have got other considerations. Some of the surveys that we've seen from the LGC and from others suggest that many will not use that maximum increase. So one survey that we've seen suggests that for upper tier authorities, about 80% will take that full 5% increase. And at least in that one survey that we've seen, at least one upper tier authority will actually freeze their Band D council tax in 2023-24, which I think is fairly extraordinary, but that's the way politicians work at times. In the chart on the right, what I tried to do was look back at previous financial years to see what proportion of authorities had used that maximum Band D increase that was available to them. And what's interesting is that actually fewer authorities took that maximum than I thought would be the case. I'd assumed it would always be about 80 or 90% taking the maximum, but in 1 year, in 2020-21, that was the case. Most authorities took about 80-85% of authorities took the maximum increase. But in other years, that hasn't been the case. I'm not quite sure always what the reasons are. I think to some degree it's when there's an election year following, councils don't take up the full amount. You can see there in 2021, 22, only 30% of Shire County Councils took the maximum Band D increase. That's because they had local elections. But other authorities in other places at different times have had different reasons for not taking up that maximum. But if you look at what if 80% of authorities do take up the full maximum increase in 23-24, you see that line there, that's where that would be. So, that's not that out of line with what's happened in other years when we look backwards. Although at times, I think probably because of local elections, other councils have been way below that. For the future for Band D, to some degree, some of the reports have been talking about the precept increase of 5% as being high, a big increase. It's bigger than it was in 22-23. That was only 3%, but although it was a two-year threshold. But if you look back over the recent past, a 5% maximum increase for social care authorities is pretty usual. Most years have had that as a threshold, and our view certainly would be that that's the kind of threshold that we'd expect to see in the future. There was at some point a connection between the core increase in Band D and inflation. You can see that in 2017-18 through to about 2020-21. But since then, that link has very much been broken. So in planning terms, our view would be to work on the basis of a 3% core and 2% precept. But, it could be, somewhere between 3 and 5% at some point. Another interesting element, I think, in the settlement is the contribution that council tax and grant funding makes to the overall core spending power. So what you'll see here is that the growth in core spending power that comes from council tax. So this is the yellow bars there on the chart. You can see a fairly constant contribution from council tax to core spending power, but the growth that's contributed by government funding, as you can see, it was negative as we had cuts in funding prior to 2021. But since then, the amount that comes from government funding has actually gone up and up and up. So for the current financial year, 22-23, and for 23-24, the contribution to core spending power increases from government funding has been around 60%. So what we've seen in the recent past is that the government actually is making much bigger contributions to local government funding, big increases in social care funding in particular, but also big increases in core grants too. We'll probably skip over this a little bit. The main thing that I wanted to draw out from here is that, and you may have seen this chart before, is that the black line, the black dotted line, is the consumer price index. And what you can see is that between 2010 and about 2016, 2017, council tax, Band D council tax was pretty static. It was frozen in most cases, or in many cases, and there were big real terms cuts in Band D as a result. But since then, Band D has increased by much more than CPI on average, but if you look across the whole period up to 23-24 with forecasts in there, I think what you can say is that average Band D is kept pretty flat, pretty much in line with CPI across that whole period, just with below inflation increases in the early part of that period and offset by above average increases later on. So now look at the core grants. So these have increased in line with inflation in the 23-24 settlement. So that's looking at revenue support grant and baseline funding level within SFA. That was relatively easy to achieve between 2021 and 22-23 because inflation was relatively low. But obviously inflation is now much higher for 23-24. CPI inflation was 10.1% back in September 22. So that was a much more expensive thing for the government to do in 23-24. As we know, that was funded from a combination of BFL uplifts, RSG uplift, and also under indexing of the BFL was funded through cap compensation. I think we know that those core grants will continue to be uplifted by inflation in 24-25. We've been told that in the policy statement. But I think beyond that, if we look forward into 25-26, the pressure on public finances does suggest that I think that unless inflation's low, that's going to be quite difficult to actually achieve. It's going to be quite expensive. And I think when we look at the next spending review round, I think I wouldn't be surprised if those core grants are limited to cash flats or or real flat increases over the next spending review period. I don't think we should be building in necessarily that these grants always automatically increase in line with inflation. The one thing that does make it difficult, though, and it's possibly the reason why we have had such a generous inflation increase this year, is that there's this difficulty with negative RSG. Cutting RSG at the moment would mean reopening the debate about negative RSG, and I don't think that will happen until we get a proper fair funding review, which is now a few years down the line. Social care funding, as we know, has been very generous, certainly in cash terms. I'm not necessarily saying that you've got all the funding that you need to balance your budget and to meet the pressures that you've got within social care, but nevertheless, there are big increases that have come through for social care and bigger increases than we thought would be the case, even until relatively recently, to be honest. The Department of Health seems to favour using the current adult RNF as the basis of distributing funding. I mean, we know there are alternatives available, but that would mean changing the distribution of funds. In our modelling, we're assuming the same approach to funding and distribution in 24-25. That's adult RNF plus a measure of equalising the social care precept. Possibly some changes in the way that £162 million of fair cost of care funding will be distributed, but that's fairly small beer in the context of the overall settlement. Although I think the issue there will be more about the quantum of funding that's available for fair cost of care rather than its distribution. Then there are issues, I think, for social care funding, I think for 25-26, where in theory at least we've got a cliff edge of funding. I think in reality, though, I think we can take the starting point as being that any funding you've got in 24-25 is the baseline for 25-26. And then in terms of planning, in our modelling, we're assuming that grant for social care will increase anywhere between 500 million and £1 billion per year. That's been the trend, and I suspect that will continue. Then the 3% funding guarantee, as we've heard, it's a new one-off funding guarantee. It's calculated based on the increase in core spending power, excluding the increase in Band D. So it's more generous than it's been in the past. So it only includes the increase in the council tax yield and not the Band D increase. It's helped overwhelmingly shire district councils, and largely because shire districts have not had such a generous increase in core grants or social care grants, and have tended in many cases to lose New Homes Bonus as well. Only 14 shire districts didn't get the 3% funding guarantee, and those who didn't get it was largely because they had increases in New Homes Bonus, and it's received by only 2 unitaries, Rutland and Wokingham. There are authorities that are lower need, or very low need, I think you could say, and didn't get such big increases in their grant funding within core spending power. Will the same approach be applied in 24-25? I mean, our view is likely, probably yes. The 3% funding guarantee is really just the successor to the floor element within the lower tier services grant. So some form of or some similar approach, I think, is pretty certain, pretty likely for 24-25. There could be a different approach. It might not be adjusted for the Band D increase. It might not be 3%. It could be something lower. But I think something like that is inevitable for 24-25, not least because for some authorities this 3% funding guarantee is now actually a very large proportion of their overall core spending power. You can see that in the chart. I've just shown you the authorities for whom this 3% funding guarantee represents more than 10% of their core spending power. And it goes up to nearly 23%, up to over 23% for someone like Dartford. So it's now a really important part of the overall settlement, and it will continue in some form, I think, in 24-25. New Homes Bonus, we're reaching that, as I said many times, it is the great survivor. It should have been canned, I think, a couple of years ago, based on what officials were saying and what the consultation papers were saying, but it keeps staggering on. I think 24-25 must be the last year, but we've said that a lot of times now. Personally, I do think that it will continue into 24-25 just because it's too difficult to change it. The government said it'll set out its future position on new homes bonus ahead of the next settlement. We want to find that out as soon as possible, but my view is I think one final one-off year in 24-25 is the most likely outcome. Cap compensation, again, I think one of the questions, or the most frequent question that we get really is this a continuing feature? Does it continue into the future? Does the increase that people have got in 23-24, is that baked in or not? And I think the key thing to remember here is that it is a continuing feature until there's a reset, as far as I'm concerned, and that the cap compensation levels that you've got this year are now baked into the way the system works, and that in fact, in the future, the baseline that we've got for the cap compensation just keeps on being added to. For next year, at the moment, there's no decision about whether there'll be a cap or a freeze to the multiplier. So assuming there isn't either of those two things, and assuming that inflation is, say, 7.4%, then the fraction for next year just rolls on to something like, say, 90 over 536. So it's got the same value in terms of how much it's worth, but obviously the figures in terms of numerator and denominator are different. So it does continue into the future. The funding that you've got from cap compensation in the current year is now baked in to funding into the future. But the value of cap compensation is now really considerable. It's over £2 billion at baseline. It's higher in reality. So it's worth a lot of, it's worth 14% of settlement funding assessment. So the issue is not what happens to it in 24-25 or possibly even 25-26. The issue is what happens to it when there's a baseline reset. Our view would be that funding just gets rolled into SFA and redistributed. But, at that point, we are looking at quite a considerable level of risk, a potential cliff edge of what happens to it. But I think in the short term, I think we can be fairly sure that cap compensation is now baked in and will continue on its current on the same methodology for at least 1 or possibly 2 more years. Finally, public health grant. It's a perennial late announcement. I've no idea why it is so late every year. Last year it was announced on the 7th of February. All that happened was they increased it by 2.8% and kept the same distribution. The spending review back in October, year before last, talked about maintaining the public health grant in real terms over the spending review period. Now, obviously, that spending review was announced before the big increases in inflation, so maybe the budgeting isn't there for that. But we'd expect something, an increase in cash terms in some respects. 2.8% for the current financial year, which was lower than both the CPI and the GDP deflator. So we don't know what that's going to be for next year. We can only wait and see. So finally, indications for the future. We've still got some small gaps in the current settlement, but then they're pretty small. We're just waiting for the final settlement now. And we also have reasonable indications for the shape of the 24-25 settlement, just some annoying gaps of things like what happens with the 3% funding guarantee, what's happening with new homes bonus. And then looking a bit further ahead, the new spending review will start from 25-26 onwards, but that will be done in the context of much greater pressure on public finances. So I think we're looking forward there to smaller increases in funding for the sector. I think we're also thinking about what happens with the Fair Funding Review and other reforms. In theory, the next year they could really happen is 25-26. I think in practice we're looking at 26-27 at the earliest, if not later. And of course that will come after a change in government, a general election in 24-25, and that might mean a Labour government, or certainly some kind of change in government. So a change in priorities, a change in approach as well. So I think in the short term, I think we know fairly much where we are in terms of funding. Beyond that, a lot of uncertainty. Okay, that's it, Martin. That's my presentation done. Hopefully I haven't overrun too much, a few minutes over, for which I apologise. But
no, that was great and a very helpful and informative presentation, gives some useful background, and probably from a personal perspective, it's a big shout out to Barking and Dagenham for getting the largest headline funding increase in the country, because without them I wouldn't be here today. And obviously it does highlight a number of risks and uncertainties moving forward, because while 24-25 we're expecting a broad rollover of 23-24, obviously subject to inflation, there clearly a lot of concerns about what happens in 25, 26, particularly if there's an autumn general election, which could delay, the settlement for that financial year. But obviously, that's some time away yet. But it's obviously potentially affects forward planning into the future and exactly what a new government, if there is a change of government, might do in terms of the whole local government funding system. And changes to business rates, even as a tax, or wait and see. So I wasn't sure if anyone has got any questions. They can post them in the Q&A for Adrian. Give people just another 30 seconds or so for that. But obviously, if people have got any questions, then they can raise them in the 11:40 session after the break. So assuming there's no questions, obviously, thank you very much, Adrian, for presenting. Obviously, you're welcome to stay around for the rest of the meeting and listen in. And, thanks again. Okay, so I'll now hand over to LG Futures. So have Caroline Newman and Chris Roberts presenting, and I think Lee Geraghty may also join at some stage for the presentation as well. So if I hand over, I think Caroline's put her presentation on the screen, so we'll hand over to you. And this is due to last for about 45 minutes or so, but obviously we'll see how it goes on timing. So scheduled to finish about 11:15, 11:20. Okay, thanks very much, and over to you, Caroline.
Thanks, Martin. Thank you for inviting us back. I think it's a double act of me, Caroline Newman, and Lee Geraghty you've got today, although Chris is there if you've got any questions. He's there in the background. In terms of the session that we are going to cover, we thought we'd have a look at council tax just for a change. Everything else seems to be NNDR, but obviously there are some issues around council tax. We've just passed the 15th of January deadline for making the declaration of what we wanted the surplus deficit estimation figure to be that we'll take into the 23-24 budget. And we have obviously run into some issues around that. Authorities seem to find it difficult to often keep track of what they have declared in one year and the next. That was one of the consistently missing bits of information that we came across at year end when it came to closing the accounts. We obviously need to know the amounts that have been declared, and authorities struggle to put their hands on it sometimes. So we're going to look at what monitoring might be able to provide for us in terms of providing a solid working paper that we can then reach for at year end when we need it. Then something else that monitoring throughout the year has flagged up, but again back to NNDR, around potential Section 31 grant deficits for 22-23. So not a collection fund deficit, but actually a deficit on the Section 31 grant that is related to that. And then we're going to have a look at what we've found around the NNDR 123-24 so far. We've obviously been supporting authorities with this through our collection fund suite and some of the things that we've come across from the numerous authorities that we've dealt with so far. Obviously, we have got our collection fund suite, and a lot of what we've found is a result of providing that support to authorities. So starting with council tax monitoring then, obviously we've, like I say, just passed the 15th of January, SI 1992, number 2428, the funding regulations require billing authorities to make a declaration at the 15th of January of what they expect the surplus or deficit to be on the council tax collection fund for the current year that we're in, that will be paid in or out of the collection fund in the following financial year and should form part of their budget. And obviously, if you are monitoring that position throughout the year, what that surplus or deficit could be, then the 15th of January declaration just becomes another month of that monitoring figure. So it is good practice to monitor this throughout the year. Obviously keeps our heads in the game in terms of what's going on. We have come across a few authorities that have actually missed making the declaration this time around for one reason or another, staff changes, etc. So obviously if this forms part of the monthly monitoring process, it is actually being done. If you do it regularly, you won't miss doing it. Hopefully by doing the monitoring as well, you will get a more accurate estimate of what that figure is, and also we'll have a record of it when it does come to close down and making the schedule of payments with preceptors, that we know what was declared at the 15th of January. So in terms of the actual declaration that has to be made, obviously the calculation is as set out there on the slide. It is very similar to the NNDR one, other than we haven't got it codified into a form anywhere. There is no equivalent of the NNDR 1 Part 4 in terms of estimating the surplus or deficit. Obviously, DLUHC have produced a form for the last 3 years in order to assist with the complexities that spreading has added to the forecasting of the surplus or deficit. that lovely yellow spreadsheet that was issued just before Christmas. However, that spreadsheet doesn't assist with in itself forecasting the in-year income for the year, which is the element of the calculation that essentially we are estimating. It just helps with the allocation of whatever figure you come up with at the end. And I'm assuming that spreadsheet is now finished because spreading will now be finished in terms of budgeting. So the calculation itself, like I say, is set out there on the slide. We know three elements of it. We know what the opening balance is on the collection fund. We know what the estimate of that opening balance was from the previous 15th of January declaration. That's what's been paid in or out of the collection fund during the current year. To the extent that that estimate of the opening balance was wrong, that is our prior year surplus deficit. And then for the in-year surplus deficit, obviously we know what the precepts are that are being paid out of the collection fund during the year. So the estimate bit really is just that estimate of the in-year income, what we expect to be billed, less estimates of bad debt provision, and any transfers to or from general fund around section 13A1Cs and transitional relief and discounts for prompt payment if anybody's doing it. To give us all together this total estimated surplus or deficit, which has to be allocated between billing and precepting authorities in the current year's precept proportions, usually, assuming spreading's not there, that will be budgeted for and paid for in the new financial year. So, in the absence of any form from government, obviously you will have your own approach to how you carry out that calculation, but given the complexity, obviously LG Futures do provide a tool to assist authorities with that. It's part of our module 2 of our collection fund suite, which you can either use to produce the calculation or check your own calculations if that just gives you reassurance. In terms of the LG Futures approach, we do a reconciliation to the revenue system. So we're starting with fact when we're doing the monitoring and the estimating of that surplus deficit. What is the income coming out of the revenue system at the particular point in time that we're doing the monitoring or the declaration? And from that as well, we also work out the necessary calculations and the resources and timing impacts. You can obviously use the tool as you see fit throughout the year, doing it monthly, quarterly, whatever works for you. But hopefully as well, the tool will help to improve communications between revenues and finance, as well as perhaps between billing authority and precepting authority, but facilitate business partnering discussions around what is the likely outturn position at the end of the year. So in terms of the approach, with or without the tool, we would expect revenue systems, revenues teams to complete the entries in the monitoring based on the revenue system, so running the revenue system reports at a point in time and completing the calculation of the income for the year at that point in time. Finance and revenues together, working with together to complete the provision movements, primarily bad debt. We don't tend to see provision for appeals around council tax because they're so small, but obviously you're going to get a better outcome if revenues and finance are working together. Reviewing the outcome and putting any strategic input in there. Are there any forecasts that are likely to change between the current position from the revenue system and what likely to outturn at? Building that in and then getting our forecast finalised. So producing that declaration and apportioning the amounts. So in terms of what the tool can do for us in that respect, so it will help us determine and verify the latest council tax income position back to the revenue system report. So making sure we have picked up all of the discounts, exemptions, etc., which you can then adjust for forecast to the year-end position if you know of anything that's likely to change to get it as accurate as possible. We can then compare that to the income that was forecast when we set the budget, so the council tax requirement taken from the CTR1 form, which we then allocate over the different categories like exemptions and discounts, etc., using the CTB1 form elements. So feeding that actual council tax income estimate into the monitoring, we can compare it to the precepts to get our in-year surplus deficit, and obviously bringing forward the opening balance and the previous year's 15th of January estimate. We've got the prior year's surplus deficit, which together gives us the total amount being estimated, which we can then pull into a clear calculation of the declaration, breaking it down into those prior year and in-year elements that you can send to your preceptors to communicate as you have to within 7 working days of the 15th of January. as well as producing, like I say, a summary position of the timing impact of what that will mean as to what resources will hit when in your general fund. Now, for those authorities that do subscribe to Module 2, if you want to send us a copy of that tool along with the declaration that you make to your own members, to preceptors, we can actually load that information for you into the Module 1 close down tool, so that firstly you know it's there for the year end, and we know that we've got the figures in the right way around. As well as we'll also be able to pre-populate it for you into the Module 2 monitoring for next year, so it'll be ready to go once you start monitoring 23-24. So feel free to send that through to us and we'll get that uploaded into the next set of tools for you. So in terms of what, just to give you a brief idea of what the actual output of the tools look like, that is the very, very bottom line there on the very first example here of what the final declaration amount is for an authority, split between the relevant authorities that can then be used to communicate to the precepting authorities what they need to be taken into their budget setting requirements, as well as a screenshot there on the bottom of the impact on resources for the billing authority. So just taking the billing authority share there, the £36,000 surplus, when that actually impacts in 23-24. If you are interested, you're not using it already, then do give us a shout. On to NNDR monitoring. Obviously, the monitoring that has been happening over the course of 22-23 has flagged an interesting issue that is going to be impacting a lot of authorities for 22-23 outturn, and that's the potential of us having a Section 31 grant deficit, as opposed to a collection fund deficit, against the budget relating to retail, hospitality and leisure relief for 22-23. Now, in fact, the issue that we're coming up against is the reverse of the one that we've faced for the last couple of years, where actually we've had an excess of Section 31 grant in our outturn position that we've then had to take into reserves, and has resulted in some very odd and often misinterpreted balance sheet positions in terms of the increase in earmarked reserves that this has created. So in terms of what has obviously happened in the past, we've completed the NNDR1 form for the year with the estimates of the reliefs that we expect to award, and then afterwards a new relief has been announced that we therefore haven't captured on the NNDR1 form. So in terms of what the authorities are receiving from the collection fund for the year, it's the NNDR1 amount, not taking into account any relief. So you are still getting the income in non-domestic rating income as though the relief isn't going to be awarded. However, during the course of the year, we've then had to award these new reliefs, so the retail, hospitality and leisure, for example, that was announced afterwards, which then creates a deficit on the collection fund for the year, but you also then are getting the Section 31 grant to fund that. So to all intents and purposes, you get your money twice in that year, or you get the income reflected twice in the general fund for the year, because you've got it firstly through the non-domestic rating income share, and then secondly through the Section 31 grant, which is obviously recognised on a proper accounting practice basis. However, the deficit is obviously reversed out to the collection fund adjustment account for the year, and therefore we've been moving the Section 31 grant into an earmarked reserve to carry it forward to offset against the deficit in the following financial year, so that we don't end up with the income twice in the first year and a hole in the budget in the second year. However, what we're facing for 22-23, like I say, is the reverse of that. What we're seeing is authorities that have overestimated the retail, hospitality and leisure relief on the NNDR1 for 22-23, because it was very difficult to estimate what the impact of cash capping was going to be, and also how many large businesses might refuse to take the relief, saying that they didn't need it. So in this case, we've reduced the non-domestic rating income on the NNDR1 form more than actually we've ended up awarding the relief during the course of the year. So we're getting less money out of the collection fund because we anticipated giving out the relief. And subsequently at year end, we'll end up with less Section 31 grant being taken into our I&E because we haven't awarded the relief. We don't need the compensation to fund it. Which means If you budgeted for the full Section 31 grant that you were expected to get based on the NNDR 1 forecast of the relief, you're going to end up with actually less Section 31 grant out of turn than you've budgeted for. Which may mean one of two things. You may therefore need to borrow, as it were, from earmarked reserves this time round to actually plug the gap in Section 31 grant. So rather than taking excess Section 31 grant to the reserve, we're having to bring money out of the reserve to fund the Section 31 grant shortfall. Now, obviously, giving out less relief over the course of the year will result in a surplus on that element of the collection fund, and that surplus can then be used to repay the reserve in 23-24. The other alternative is, it depends what your authority did with CARF. We may have some Section 31 grant there that we can use to offset the shortfall that we budgeted for. So CARF wasn't included on NNDR 122-23. So we haven't budgeted for the Section 31 grant, most likely. That then goes with the awarding of the CARF in 22-23. So in theory, we'll be bringing in the CARF Section 31 grant into the INE in 22-23 if we didn't reflect it in 21-22, and that may go to offsetting the shortfall in Section 31 grants so that we don't have to borrow from reserved or don't have to borrow as much from reserves. So in terms of where our monitoring module have flagged that up, you can see that the top screenshot there is an authority that has seen a reduction in their retail, hospitality and leisure relief that they're expecting to give out between an NNDR 1 and an NNDR 3. But equally, this authority didn't give out all or any of their CARF relief in 21-22. It's all going through in 22-23. So effectively, we've got an offset there of CARF relief against a drop in RHL, which means actually the reduction in Section 31 grant is a lot smaller than we might otherwise expect. And we're having to, our tools suggest a small amount that has to be borrowed from reserves to make up this shortfall in the Section 31 budget. Obviously, the other scenario that we're seeing, as we've explained, an authority here that's seeing a reduction in RHL, but actually awarded all of their CARF in 21-22. They're not applying any in 22-23. The whole impact of the retail, hospitality and leisure relief reduction will be falling through into the outturn for 22-23. And subsequently, we see a much bigger drop in the Section 31 grants that are due to the authority for the year at NNDR 3 compared to what was perhaps budgeted for at NNDR 1. And as such, we're having to suggest a much bigger borrow from reserves at the year end to plug that shortfall in Section 31 grant, but which we can replenish in 23-24 due to the surplus that will fall out of the collection fund at the year end. So just something that using this monitoring tool down to that level of detail has flagged up that can actually help us to deal with it now rather than it becoming a shock at year end, as it were. So hopefully we can see that monitoring collection fund, both council tax and business rates throughout the year is good practice and gives us a heads up in terms of what's coming, and also provides information, especially for future close down purposes. So that's everything I've got to say around monitoring. I think Lee is going to join us now to talk about revaluation.
Thanks, Caroline. I am here, don't worry.
Oh, sorry. You are there.
That would be quick. Good morning, everybody. Who would have known there's another tax aside from business rates in local government, eh? Council tax. Wow. Right, so thank you, Caroline. So revaluation. I know a lot of you will have heard me talk about it recently in the last few months, or Chris or Caroline. But I just wanted to recap on a couple of things before going really on to what we've been finding on the NNDR1 forms to date. I know that a lot of you haven't finalised yours, so I thought it would be worth just sort of blitzing through what we've seen so far. So just on revaluation first, obviously it is supposed to be revenue neutral at a national level and also at a local level, thanks to DLUHC's sort of repeated 2017 methodology of altering your top-ups and tariffs in order to offset the change in the amount you can collect locally. Obviously, the amounts that we do have within the 23-24 settlement are only provisional changes, and we need to be mindful that they're based on 21-22 data and the provisional list. Now, I wouldn't expect that much of a movement between the provisional and final lists from the VOA, but it is your NMDR3, and if you do make significant changes to your more subjective elements of the form come close down for 22-23, it may alter the adjustment in a more material way for not only 24-25, but they're going to backdate that to 23-24 and potentially future years. So it's something to be mindful of when you're completing the form, not to be mindful that it will alter your tariff or top-up even. Those authorities with the bigger variance compared to the national average of just over 7%, those with a more material variance either way, are those that will see the greater change potential if their income changes by more during the years, because it is a factor of that RV change compared to the national average. So in terms of the work involved around revaluation, so I think most of you are there in terms of understanding why the adjustment happened, and you understand your tariff and top-up adjustment. We'll come back to the multiplier aspect, because it's really important to understand how a frozen multiplier, as we've said over the last couple of months, can move so much. Then there is the sort of, as I said, the more subjective decisions around the NMDR3 that we need to be mindful of. Next, factoring in the adjustment next year. So if your top-up or tariff does change by, say, 100,000, obviously not building that into the base, knowing it's a backdated element and it's sort of like a double change in effects, it's 2 years worth, and then actually accounting for it properly within 23-24. So, and Chris, I drafted this slide, then Chris, but obviously aside from actually applying all the new RVs to your system as well and making sure that software updates are done, just that small task. So we will be supporting authorities come close down with the need to be mindful on their 22-23 NMDR3, and obviously targeting those authorities, speaking to those with the greatest RV change and the greatest risk. Because the last thing I'd imagine anybody wants to do is just on a box where you don't know whether to put 1 or 1.5 million, for example. You choose an amount and it costs your authority real resources. It's not just cash, it's real resources over the 3 years. So moving on to the multiplier itself, so obviously a lot was made of it being frozen, and I know some of you will have seen this slide more recently. So the multiplier was at 49.9 pence for 22-23, and do look, in the first instance, reduced it down to 46.5. Now that was based on 7.3% valuation reduction. That wasn't the published data in November, but a list back in September which wasn't published. So it was a bit of a surprise. It went down by 7.3 to us, at least. They then have to build in an appeals allowance, which is really important for obviously NMDR1, which is how much they think the national list will be reduced by in future years for successful appeals. And that really is correlated in my mind with the RV change. We've seen the 10% change back in 17, given a 4.7% allowance, and much higher changes on the previous 3 revaluations, given 6.8 to over 10% for the appeals allowance. So with the 7.3 only allowing 3.2 suggests there is a correlation between the two. Obviously any business can appeal, even with the RV reduction, but if I was sitting there with an RV increase locally much higher than the national average, I'd be a bit more nervous about using just the 3.2 allowance, I'd suggest. And lastly, in order to administer it was nice and rounded back up to 49.9, they managed to squeeze in, as Ivor has been describing in the last few weeks, 3.74% for inflation. So obviously by squeezing in that 3.74, it's allowed them not to have to put the multiplier adjustment up by the 10% or 10.1% CPI increase in September last year. So that's why it's only gone up by the balancing amount of 6.4. So obviously those 3 changes are really important in understanding your resource projections, not only what the appeals allowance is, but why inflation is in both elements, as it were, both Section 31 and the business rates. So moving on then, we have had the pleasure, Ivor, Chris and myself, of reviewing over 50 NMDR1 forms in the last few weeks, looking at variances between years, the implications of revaluation and benchmarking, appeals, bad debt, and also projecting resources. And I think our initial observations on those, and there's still quite a lot outstanding, and that really relates to the first point, which is a lot of authorities have still had software issues and still have software issues in some cases, and it's delayed their production of the forms. So to suggest we've got another 20 forms to review between now and next Tuesday, and I imagine most of those authorities wanted to get it done far quicker than that, but there has been a delay. I think in terms of the RV shift, there's a good awareness of what's gone on with revaluation, and also the implications for resources of that front. So the fact that it happened in 2017 and it's happened again in a very similar way has provided authorities with that reassurance for anybody who can remember that far back. And even those where they've had that complication of the move from the local to the central list, I think that was handled really well by DLUHC, and I think that's shone through in terms of people's understanding. The amount set aside for appeals is perhaps the most interesting line, because it's a new list, and it's whether how much of that sort of awareness of what you should put in is filtered through. So some authorities use external rating agents such as Analyse Local, and they've been given a sort of low, medium, high amount as to what to put in. Others have put in the 3.2%, and others have put in others have intended to put in 3.2%, but it really does depend what the denominator is in terms of what they're measuring the risk against. So we'd suggest on our benchmarking, we use the net rates payable plus the funded reliefs, because if obviously a business is successful on funded relief for part of the amount they pay, you'll end up refunding the Section 31 grant to government for the other aspects. So, and it also gives us, more important, it gives us a good sense of timeline data as well, so we can compare between years, because the sum of those two is broadly similar, as opposed to net rates payable, which, as we know, has been all over the place in recent years. And largely authorities have centred around that 3.2 or using their external rating agents. But with the ones that sort of depart from it, if you're lower, if people have increased by lower than the national average, they tend to gravitate to the 3.2. But I suggest those that are materially above the national average for RV change are looking to be perhaps a bit more prudent in terms of what they put aside. I mean, the other thing I'd always say is be mindful that obviously there's a budgetary consideration. It's all right saying it would be right to put more aside, but it might not be right from an affordability perspective. And then there's also the wider issue about putting resources aside about those considerations when arbitrarily just putting money aside within a provision. The next point is something that Caroline's just covered, really, which is the complications around Section 31 grants. And if we just took Part 4 alone and looked at business rates income, there's some variances there that might be confused, as it were, in terms of a gain or loss in resources. So there is those local authorities with no change in their business rates received, but they've had ups from CARF and downs from extended release in terms of Section 31 grant, but there's others at the two extremes as well. So it's really understanding, are you at a net neutral position because things have changed, or you're at one or the other with your Section 31. And I think that's why understanding the total position, be it at Q3 in terms of business rates income plus Section 31 grant, is really important. And lastly, to end on a more positive note before I hand back to Caroline, it's just that what we'd expect to see, which is a 10% increase in resources from business rates, is being seen consistently across all the authorities. There may be in-year movements for 22-23 for appeals or for bad debt, but for 23-24 we are seeing that increase in resources, albeit through both business rates and Section 31 grant, which is reassuring in terms of the increase in CPI is translating to increased resources, but also from just a form completion perspective, there's nothing that's being completed erroneously or misunderstood, and therefore authorities not ending up with the right amounts. So yeah, I mean, that's the first thing we check, and it is being seen. So much more positive. Caroline, I'll hand back to you if you want to wrap up.
Yeah, so just to make those points, obviously your council tax declarations should have now been completed. If they haven't, obviously we need to get on with them very quickly and communicate them to your preceptors. But obviously if you have done them and you want to review them, then you could use the monitoring tools to do that. But just some kind of monitoring gives you a working paper to then remind you to obviously do it when it comes to the 15th of January, but also gives you that working paper in your hand that you can use at close down and say, these are the figures that we're expecting to pay over the course of the new year. Business rates is challenging this year, it's challenging every year, as we say. Funded relief's causing the variances again, obviously looking at whether your retail, hospitality, leisure relief has gone down from what you forecast on the NNDR 1. Have you awarded CARF this year, or did you award it last year? So can you offset one against the other, or are you going to have to borrow from reserves to fund that? In terms of looking at your NNDR 1 for 23-24, we have got some limited availability support left to look at your NNDR 1s if you're not booked on those. If you do have module 3 and you haven't booked your slot yet, then please do. Obviously, the 31st of January is fast approaching in terms of submission deadline. Equally, a reminder as well that if you want to submit your council tax declarations to us so that we can populate your modules 1 and 2 going forwards, then please do that. The outturn position from the NNDR 1 23-24 when you get it filled in should obviously be reflected in your budgets, as should the outcome of the council tax declaration. Passing through your NNDR 1 to us once it's completed, we can update your medium-term revenue resources model and get that across to you for medium-term financial planning. And then obviously looking forwards, we're going to start planning for close down. We're going to be doing some webinars on what you can do to prepare for close down now, as well as training on the updated module 1 tools for the accounting for close down 22-23 as well. So obviously it's that busy time of year, lots going on around both council tax and business rates. I think that's everything we've got to share for now, Martin. I don't know if there's any questions. I can't see in terms of if I stop sharing my screen, I can maybe see if there are any.
No, Caroline, there aren't any questions at the moment. So, but obviously I'd like to open up to anyone who does have a question. Obviously you can make a comment in the Q&A or just put something in the chat and we can invite you in as well to sort of speak on the screen. So doesn't seem to be any comments or questions at this stage. So I think I'd just like to say thanks to Caroline and Lee for their presentation. Clearly, if there's any wider questions or issues you have, and obviously some of you will be subscribed to the various services that LG Futures and Pixel offers, obviously feel free to contact Caroline, Lee via the general LG Futures address, and Adrian as well, if there's any sort of further questions or issues or concerns you have. I mean, clearly, Caroline's highlighted a number of issues, and obviously the issue about the 22-23 Section 31 grant reconciliations issues, and the issue we picked up in London as well, whereby we've sent out a survey to all our billing authorities yesterday, just asking them to confirm their CARF assumptions and also their retail relief assumptions, so we can assess the movement, because we would expect, obviously the CARF position, if you just look at Part 4 of the NNDR 1 returns, obviously the surpluses would be, if there are any, would be understated because of that, and any deficits would be overstated. But then you've got the offsetting impact of the movement in retail relief, because clearly a lot of authorities would have potentially overestimated the scale of this, because they couldn't obviously see the impact of the £110,000 cap per business, which clearly would have meant that an awful lot of local authorities would have had much larger estimates than were the reality, because they weren't clear how their big retailers, their big major companies that operate nationally would have managed on that. So that's going to cause a challenge, and it's important that you bear this in mind before you start allocating any 21 or 22, 23 surpluses or manage any 22, 23 supposed deficits, to factor those issues into take those issues into account, because there are some quite large sums involved. Clearly, CARF was £1.5 billion nationally. I mean, vast majorities have allocated almost all of that, and then retail relief was nearly, I think, 2 billion nationally on the basis of the NNDR 1s, even though the government had only budgeted for $1 billion or so. So the cost in reality is probably a lot lower than was implied by the NNDL1s last January.
Actually,
I think
Martin,
that
I had a question for Caroline, actually.
feel free. So hope they're not going to charge you for it, but anyway.
No, the question was with the appeals allowance of 3.2%, and that kind of being a guideline for people to use for when they actually set their appeals provision. Have you seen any authorities go with a different assumption? Was it evidenced? Is any kind of I guess I'm asking, is any authorities for good reason, with good evidence, have gone with a different level of appeals provision?
Do you want to answer that one, Lee? I mean, generally, I would guess it would depend how much above or below the national revaluation you might be. If you're well above, then you'd expect maybe to put away more than 3.2%, and vice versa if you're below. But I don't know what Lee's seen in terms of the NNDL1s.
I think authorities have just applied their usual approach. So if they use Analyse Local, for example, then they're used to getting their report and they're putting it in the first instance. And then they have a conversation with us about, a sense of realism in terms of where that sits, because the thing is, it's the list hasn't even started yet. So estimating the amount of appeals provision is a step into the unknown. But most have gravitated towards the 3.2. But like I say, those with that, like Caroline said, I think of those in the East region, for example, which has seen the highest increase in RV, and particularly Hertfordshire and areas such as that, do have a greater appeals risk, in my opinion, going forward. Yeah. And so they are perhaps being mindful not to sort of bake resources into their budget, which they're going to have to pay out in future years.
Yeah.
And I think that does, as Lee's highlighted, the huge distributional impacts of the revaluation, which in some senses partly reversed the position in 2017. So you've got very large reductions in the West End retail sector. You've got Harrods and Selfridges with their rate of values going down 45%, John Lewis and Oxford Street going down over 60%, and that's replicated, throughout the West End, and also sort of in Hammersmith and Fulham with Westfield, Shepherd's Bush. And then you've got very large increases for industrial premises, and we're certainly seeing in outer London some quite big increases for offices. So it's not really necessarily a uniform position even within regions. It does very much depend on the makeup of your local tax base, and therefore, if your rateable value is going down 50%, you're probably less likely to challenge it than if your rateable value has gone up 50%. So, that is obviously a factor authorities will need to take into account. But I think at this stage, it's probably sensible, because at least you can justify it for 23-24 budgeting to sort of take the national average. But clearly, if you're at either end of those extremes, then you may want to take a different perspective on that. But I think clearly you need to be informed by what's happened, and it's always difficult to predict what's going to happen in the future. And bearing in mind that was only a draft list, and there will be some changes between then and the compiled list that's published on the 1st of April, which will, at least in terms of tariffs and top-ups, lead to further reconciliations in 24-25, then get reversed in 25-26. So I think that challenge with all of this, there's all these multi-year issues that impacting on the system and creating a lot of confusion. And, as we've highlighted the 22-23 issue, there's also, which we could pick up at the main presentation, around the 21-22 reconciliations, the email that hopefully you should have all got from Amy Palmer at DLUTCH last Thursday, which was a 13 megabyte spreadsheet, which just sort of highlighted, the large sums that preceptors will be receiving in Section 31 grant reconciliation payments in the next few days, and the large sums that billing authorities will need to repay by the end of February for the retail, leisure, hospitality relief, primarily for 21-22. So in London, you've got our billing authorities going to have to repay DLUTCH nearly £1.5 billion at the end of February, but they'll be getting, a large proportion of that from the GLA a week or so before, and they would have been receiving the collection fund deficit payment from DLUTCH in instalments over the year. So it all should net off. So, but obviously people might get a bit of a shock if they look at that. Westminster got to repay £300 million to DLUTCH at the end of February, whereas in reality you will have hopefully the vast majority of the cash, obviously subject to any movements as a result of the 21-22 outturn position, which will be picked up in terms of future year surplus deficits. So I don't see any other questions or anything that anyone's raised. Clearly we can pick up things in a bit more detail at 11:40 the main presentation. So I suggest now, as we've allocated time for that, just take a quick 10-minute break, and then we'll restart again just after 11:25, where Mike Heiser will make a short presentation. So just a short comfort break for everyone, and we'll see you all in about 10 minutes or so.
Cheers.
Okay, thanks very much. Okay, so welcome back, everyone. So I think the 10 minutes are up now. So if we now move on to the next part of the meeting. So I see Mike Heiser is also back on the call, so I'll hand over to him to give a short 5-10 minute presentation on where we are from the LGA's perspective. Okay, over to you, Mike.
Okay, thank you very much, and thank you, Martin. Good morning, everybody. I don't think I've got very much to add to the very full presentations that Adrian, Lee and Caroline gave. In terms of the final settlement date, we certainly haven't been told it, but I'm sure that they will try and see if they can get the debate in before Parliament rises, and Parliament is going to rise on the 10th of February, so I'm sure they'll try and get it in that week, in which case the final settlement would be published sort of up to 2 or 3 days earlier. Adrian talked quite a lot about core spending power increases. Overall, I think we would expect the final core spending power increase to be a bit higher. Martin will confirm, but I don't think they put the mayor's, for example, £20 flexibility in the provisional core spending power increases. And once, obviously, you put that into core spending power, you will go up a bit. We sent our response. I will put it in the chat, and we can and give the people to circulate it. You will have maybe noticed, if you look at it, that the language was a bit less welcoming. Well, once we took it through members were keen to point out that well, it looks fine for 23-24 and 24-25, but it's driven to an extent by high inflation and by the one-off grants, which there is absolutely no knowledge of how they're going to continue for 25-26. So the next thing that we're expecting is the spring budget on 15th of March. The Treasury have asked for submissions by the 1st of February. We will be submitting a letter to the Chancellor, and that's being cleared at the moment. And once it's been sent, we'll put it on our website in the normal way. So just to come to business rates, as was being said, rateable value is up overall in the 2023 revaluation, but there's some big movements up and down. Most retail down, most industrial and commercial up. Some council premises have gone up, particularly those where the cost of construction is taken into account. I mean, schools have gone up, but councils don't have to worry much about that, even if they're maintained schools, because that's picked up in the dedicated schools grant, so the DfE will pay. But some other education buildings you may have to think about. The VOA has been offering and is in the middle of regional briefings to councils. I haven't had any feedback about how they have gone so far, so it would be useful to know something about those. The 2023 transitional relief regulations were passed. Note, by the way, that to satisfy the legal requirement for transitional relief to be revenue neutral, the regulations include a 2027-28 supplement of 3.3 pence. However, the government's policy is that the next revaluation is going to be 2026, and so they have no intent of actually applying that, and they will also remove, when they change the primary legislation, funding transitional relief. However, of course, that requires primary legislation. The non-domestic rating bill that was announced in the Queen's speech but has not yet been introduced into Parliament. So I think it's a matter of watch this space, whether they manage to put it on their legislative timetable in this session, or whether it then becomes a thing for the election. And we all know that the Labour Party, for example, have said they will abolish non-domestic rates without coming up with very more details other than that. Moving on to the reliefs, the accounting treatment has been talked about. The guidance for the reliefs, for the 23-24 reliefs, and for supporting small businesses has been published. We are hoping, there's absolutely no guarantee that there will be no more emergency reliefs this time announced in the budget as they were in 2017, so people can get on with implementing them now. CARF was also mentioned. The final figures for CARF that were published towards the end of last year indicate that 80% of CARF went out. That's much better than we anticipated at some stage, but of course the other 20% will have to be repaid to DLUC, probably, as people have been indicating in the chat, in the process of the 22-23 NNDR3. I suspect that there might have been, had rather less gone out, there would have been more pressure to have repaid it to DLUC earlier, but I think it's still a matter of watch this space. They haven't exactly clarified what the arrangements will be. Can I touch briefly, if people are interested, on the energy bill support scheme? The particular one I want to touch on is the alternative funding arrangements that were announced in December, and which councils are supposed to be responsible for distributing. This is particularly for households not eligible for the main scheme, such as residents of Park Home and some care home residents. So the scheme was due to have commenced on Monday, the 23rd of January, last Monday. On Friday, the 20th of January, BEIS wrote to council saying it won't be commencing on Monday, the 23rd of January. We will communicate with you as soon as possible. They did communicate with councils yesterday, saying that now they are committed to opening the scheme for applications the 27th of February at the absolute latest. But they're working to prepare local authorities to launch from the 20th of February. It's going to be a sort of hybridish scheme in that there is a gov.uk portal to apply, which is being worked through a system called Salesforce, and BEIS hope to let councils have the draft guidance for the scheme, data sharing agreements and grant determination letters, and also support payments and new burdens funding in the next couple of weeks. Watch this space. We're in touch with BEIS and are happy to take up any issue with them, but so far I think it may have been an example of don't offer what you can't deliver in terms of the timetables. On new burdens payments, by the way, people will know that the new burdens payment for CARF and for the previous RHL schemes are still outstanding, and we've been pressing DLUC for updates. They've said in their latest business rates information letter that they will try and pay it, but again, I think it's watch this space. Something briefly on council tax. You may have noticed alongside the settlement, a 100 million council tax support fund was announced. Guidance and allocations were published on the 23rd of December, which is good. It's allocated on the basis of all LCTS recipients. and the government expects councils will use to fund further reductions in council tax liability of those receiving LCTS with an outstanding council tax liability by up to £25, and then the rest will be available for distribution. Couple of other issues which other colleagues lead on while I'm talking to you. So on statutory investment guidance, we're expecting a consultation on the revised investment guidance to bring it into line with other elements of the Prudential Code early in 2023, and revisions to the minimum revenue provision guidance may come in at the same time. I don't think we're expecting either to be problematical. On the IFRS 9 statutory override, which particularly affects pools investment, DLUC wrote to all CFOs saying that there would be a 2-year extension. We're waiting for the full consultation response and for indication of long-term plans. It would be helpful to gauge how much of a problem there would be if there's an indication that there'd be no further extension after 2 years. And SIPFA and the ICAEW are pressing for that extension. Briefly on audit, there was an NAO report that shows the system is still in crisis. We issued a press release that was quoted in Public Finance. If there is a PAC inquiry, we will engage with it. Draft accounts deadline will revert to 31st of May 2023 unless DLUC change the regulations as they have in the past. They said they will consult on reverting back to normal, but they haven't yet, and we're continuing to press them on that. And on infrastructure assets, there's a temporary solution now in place, but it's not clear where that's going to have an impact on backlog. So, one other thing, people talked about various tools. One tool which is available free is one that the Institute for Fiscal Studies have worked on. I think some people have been involved with them in their reference group. That has now been rolled out, and particularly if people want to do work on looking for individual councils, what the effect of things like resets and the fair funding review are, particularly resets, it is actually quite useful to use. I'm sure they will appreciate people using it and giving them feedback. Thank you.
Okay, Mike, thanks very much for that. So now there's an opportunity for people to ask questions either through the chat or through the Q&A, and I see we had a few responses that came through during the presentation, so I think we sort of take those one by one, and then I'll just do a quick roundup at the end. So obviously partly links into the timing of the next meeting, and I think there generally seems to be support for having one in April, because I think, as Tanya's highlighted, we would expect, given the accounts have got to close, the draft accounts got to be published for 22-23 by the 31st of May, that the deadline for the NNDR3 will need to be the 30th of April, in practice Friday the 28th, because I think the 30th is a Sunday, so to ensure that major preceptors have all the relevant data so they can prepare their draft accounts. I think in terms of other issues and waiting for any sort of further questions that come through, clearly important deadlines imminently are the NNDO ones that are due on Tuesday, so I'm sure billing authorities, if they haven't already completed them, are busy working to complete those, and obviously make sure to inform your major preceptors if your return is likely to be delayed as well as DLUC, because in reality we probably need it more at this stage than DLUC. You won't do very much with it for a few weeks until they start working out the Section 31 grant payments due, etc. Council tax collection of unsurplus deficit returns were due to major preceptors by last Tuesday, the 24th. So that's obviously an important return, particularly obviously reflecting the final impact of the 3-year spreading for 2021. And, you know, we are seeing some very different outcomes across our billing authorities in London in terms of some material surpluses, some material deficits. So it's obviously interesting to understand the story behind that. I think we've highlighted, you know, the issues around 21, 22 closed down, as Mike highlighted, around the delays to audit. Some authorities still got to publish their draft accounts, so it could be some time before we see a final outturn position. or for 21-22, but we do have the initial reconciliation payments based on the Amy Palmer email that came out last Thursday. So it's important all authorities read that and understand the payments that will need to be made by billing authorities, in most cases DLUHC, by the end of February, and the payments that preceptors will receive to reflect the reconciliation payments for the 21-22 retail relief scheme that was announced after the NNDR ones for 21-22 were prepared. So that obviously results in a very large movement, as in 2021, from via DLUHC from billing authorities to preceptors and Section 31 grant, offset by preceptors repaying the resulting deficit through their instalments, or in the case of the GLA, through a lump sum in March, or as it will be February now. And obviously that may impact on, the instalment schedules you have for February and March. So we'll be advising our billing authorities shortly in London that, the February and March instalments will need to swap, because we worked on the basis that all these adjustments will be happening in March. Similarly, you have the the levy and safety net payments won't be confirmed now until March, and I presume settled at the end of March, because I think DLUHC are laying some further regulations. So that's an issue to keep out an eye on if you are likely to pay a levy or in receipt of expected safety net payment, as a number of authorities are, particularly districts and some London boroughs. And I think just generally moving forward, clearly 23-24 we have got an improved settlement, but there are still a lot of challenges moving forward. What exactly will the inflation rate apply for 24-25, and how will the impact of the general election and the new government coming in change the approach around the expected business rates resets and fair funding review, and even the future of business rates as a tax, although where the Labour Party proposed to abolish it, but then when you read their alternative, it looks exactly the same as business rates, because it still talks about having revaluations and local rating lists and etc. So it'll be interesting to see how those ideas develop. We also have the council tax review that the Secretary of State has announced. So while we don't expect any fundamental change to be able to come through before the general election, it'll be interesting to see how that moves forward, and whether that will start impacting anything in 24-25 or future years. And I think just generally the importance of seeking advice, speaking to contractors. We obviously had consultants on this call from LG Futures and Pixel, but also speaking to other authorities where just to share issues and concerns, because all authorities are going through the same issues and challenges, dealing with all these multiple year and conflicting issues and the associated cash flows and accounting challenges. So I think it's important, use forums like this and other networks you have to seek advice. So I think there's no further questions. I think there's a couple that was raised earlier around CARF relief and the Section 31 grant reconciliation process. So I think, as we've indicated in London, we're doing a survey of our billing authorities to try and assess what that means for the Part 4 calculations and what the true surplus deficit position is and what this means. So for authorities outside London, you may just want to liaise with your preceptors on that, just to understand all the timing and phasing implications of that, because that's an important consideration for your budget over the next couple of weeks, so you can actually understand really what the true outturn position is for 22-23. And just, I think, keep an eye out for communications from the LGA consultants and departments, so you're clear what's happening. So I think that's probably all from us at this stage, unless there's any final questions. So I'll discuss with Jamie and Chardash around the timing of the next meeting, but there seems to be majority support for April. So I think we'll be looking to have something just after, perhaps the final week or so of April, just after the Easter break, just before the NNDR 3 returns are due to be submitted, because that might be a good opportunity for authorities to discuss issues before they have to finalise those. So we'll come back to you on a date for that. And I think just thank you to all the presenters, Caroline, Mike, Lee and Adrian, for presenting today, and obviously thank you all as well for attending the meeting, and hope you have an enjoyable Friday afternoon. Hopefully not all spending your time completing NNDR 3 returns, unless you're in London, where obviously we'll keen to have them as soon as possible. Okay, so thanks very much again for your time, and enjoy your Friday afternoon, your weekends, and we'll hopefully see you for the next meeting just after Easter.
Great.
Okay. Thank you very much.
Thank you, Martin.